Hi, today we're going to be going through the market outlook for 2023 from LPL Research. After 2022 being one of the worst years for investors, particularly the 60-40 portfolio, we're going to cover where we might go from here. During the last couple of years, it's no surprise why we might be striving for more balance. If 2022 was about recognizing imbalance that have been built in the economy and starting to address them, we believe 2023 will be about setting ourselves up for what comes next as the economy and markets find their way back to steadier ground, even if the adjustment period continues. I'm Bill Brancaccio, co-founder of Retirement Wealth Partners here in Westchester, New York. I'm a certified financial planner and the president of the Financial Planning Association of Greater Hudson Valley. And I'm joined here today with my business partner, Byrke Sestok.
Hi, I'm Byrke Sestok, certified financial planner and co-founder of Retirement Wealth Partners. Additionally, I serve on the national board of the Financial Planning Association, a 19,000 member organization. Bill, tell us a little bit about what to expect from the overall economy.
Thanks, Byrke. The global economy will likely slow from the upper 2% range that we had in 2022, down to the mid 1% range in 2023. Much of this is going to depend on China's growth path. An important aspect for investors is the U.S. appears to have fewer headwinds to growth compared to Europe and other developed economies. The divergence between the domestic and international economies is the most obvious in the inflation regime. Germany, for example, is still experiencing accelerated rates of inflation, whereas the U.S. has likely moved past the peak. The longer inflation is uncontained, the riskier the growth prospect. One reason we're currently seeing a healthy debate in the likelihood for a recession is that for most of 2022, not all of the metrics were flashing warning signs. Recent data, though, is giving us more clarity. The Conference Board's Leading Economic Indicator Index, LEI, has declined for 7 of the last 9 months, showing the economy could be entering a period of significant and broad-based contraction. The decline is predictable as many sectors such as housing started slowing months ago. Since the inception of the index, a decline of this magnitude over a 6-month period has always foreshadowed a recession in subsequent quarters. As such, we think recession risks appear more probable by the beginning of next year. If the economy does fall into recession, the cause will likely be from the consumer sector retrenching after years of inflationary pressure, high housing costs, and slow real wage growth have kicked in. Something that the Fed has repeatedly warned investors about is the potential for pain from the fight with inflation. That pain is most likely associated with an expected increase in unemployment as the job market cools from a slowing economy. The job openings and labor turnover report was hardly center stage until Fed Chair Jerome Powell used a press conference to highlight the number of job openings in the economy. The pandemic caused these 3 metrics to become off balance: the ratio of openings for unemployed, the number of new not in labor force, and the percentage of firms having difficulty finding qualified workers. Investors should watch these metrics closely throughout 2023 as the economy leads to more balanced labor market. Housing plays a significant role in consumer spending, and the investor should monitor the housing market as a bellwether for the health of the consumer. Consumer spending is roughly 34% of their total spending on households. So a decline in housing-related costs should give consumers more discretionary spending. This slide comes from our partners over at Franklin Templeton. The recession is one of the most anticipated ever. The probability over the next 12 months, according to the Philadelphia Fed survey of professional forecasters, has hit an all-time high for anticipation of a recession. Another slide that we obtained from them is the U.S. Recession Risks Indicator. There's 12 variables that have historically foreshadowed a looming recession. The overall dashboard is currently signaling a recession. This is a big change from the summer months, as you can see here, with the green expansion and yellow caution items being much more prevalent back over the summer. Now it's flashing much more on the recessionary side. This is what some previous recessions have looked like for this dashboard. So this gives you an idea that we may be heading into a recession, although that's not a certainty. I'm going to pass it back over to Byrke to discuss what we're seeing in the stock side of things.
Thanks, Bill. If stocks are going to go higher in 2023, a prompt end to the Fed's rate hiking campaign will likely be a key component. The timing of the last rate hike of this cycle is uncertain and won't be clear for a while, but our view is that the Fed will pause during the first quarter of 2023 amid an improving inflation outlook and loosening job market. Should that occur, stocks would likely move higher, consistent with history. Stocks have tended to produce solid gains after hiking cycles end, including a 10% average gain 1 year later. Through many economic downturns, recessions, and geopolitical crises over many decades, the stock market has always recovered. Those patient, courageous investors who are able to take advantage of those declines have usually been rewarded nicely. Following down years, the S&P 500 has risen an average of 15%, with positive returns in 15 out of 18 years. Our base case for S&P 500 earnings per share in 2023 is $220, similar to where we were 2022 is tracking, and about $12 or 5% below the consensus estimate as of November 15th, 2022. Revenue will continue to get a boost from inflation, as many blue chip companies during the third quarter earnings season have demonstrated an ability to pass along higher prices due to their pricing power. But margins will likely compress further over the next several quarters before support from lower costs potentially arrives. LPL's Strategic and Tactical Asset Allocation Committee sees fair value for the S&P 500 at 4,400 to 4,500 at the year end 2023 based on a price to earnings ratio of 18 to 19 and $240 per share in S&P 500 earnings in 2024. That target is also derived from probability weighted scenarios and based on various paths for the economy, inflation, interest rates, and earnings. So Bill, why don't you give us a little glimpse of what we see for the bond market in 2023?
Thank you, Byrke. The path for interest rates will certainly be largely influenced by the Fed's behavior, which will be guided by economic growth and inflation data. Equally important is the level of non-U.S. developed government bond yields, as foreign investors are an important buyer of U.S. treasuries. Higher foreign market yields, all else being equal, generally dissuades foreign investment in the U.S. markets. These are the range of scenarios we think could play out over the next year. However, given our view that the U.S. economy could eke out a slightly positive economic growth year, we think that 10-year Treasury yields could finish somewhere around 3.5% by the end of this year. There are some expectations for various fixed income markets under different interest rate scenarios. If interest rates don't change at all, the best expectation for performance over the next year would be the index's starting yield. Because companies were able to refinance debt over the last few years and push out maturities, only 1% of existing debt needs to be refinanced in 2023, and less than 10% needs to be refinanced before 2025. So the need for companies to refinance existing debt at these higher debt levels seems to be currently muted. Byrke, why don't you talk a little bit about geopolitics and policy?
Sure. Thanks, Bill. Uncertainty surrounding the course of the Ukraine-Russia conflict has thwarted diplomatic attempts to reach a negotiated settlement. The intense military campaign involves a significant contribution from NATO toward the Ukrainian war effort, specifically from the US. Depending on how long the fighting continues, it is expected that many of the NATO countries, including the US, may debate the financial burden. Markets historically have navigated regional conflicts fairly well, despite the heavy toll. The largest market vulnerability remains the war's impact on inflation. The commodity supercycle, spurred by China's hyper-growth rate in the beginning of the century, has waned significantly. As China's leadership is focused on containing COVID-19 at all costs, the once strong economy has stagnated. Additionally, the boom in real estate projects has slowed dramatically as developers are mired in debt. Turning to policy, the 2022 midterm election was closer than many expected, but in the end, voters chose to rebalance the power dynamic in Washington. As expected, Republicans gained enough seats to win a narrow majority in the House, while Democrats held on to their slim majority in the Senate. Despite Republicans' narrow House majority, their victory in the House significantly shifts the balance of power, since only legislation with broad bipartisan support will get passed now that the new Congress was sworn in. Perhaps the most important outcome of the election is simply that we have it behind us. Historically, midterm years have been volatile for markets, and 2022 has been no exception, but the third year of the presidential cycle has historically been the strongest, and a weak 2022 may help set up that pattern again. We would add a note of caution, though, that increased fiscal stimulus in anticipation of the presidential election has often supported returns in the third year of the cycle, and we are unlikely to see that added tailwind next year. The major takeaway from the election is that we now have mixed government. Markets have tended to favor mixed government since neither party is able to give it into its worst excesses, and any legislation that does get passed is subject to compromise. It may also be that the government that governs best is sometimes the one that governs least, and mixed government has a tendency to create gridlock. So that's our short outlook of what to expect in 2023. Certainly, the uncertainties that are out there are sufficient to change the true course of this year significantly. We are, as always, monitoring these changes to make adjustments to our investment management. Bill, thanks so much for joining me today. With that, we wish you a terrific 2023, and we are here for you as your questions and needs arise. Thank you for watching. See you soon.